This is Capital Success by Chris Shepley, a series where we talk about all things day trading, the world of investing, and how to play the game of capital success. I hope you find value in this. So, what is a crypto wallet? Well, in simple terms, a crypto wallet is what is used to store and manage your cryptocurrency. I like to think of this as a digital purse or potentially even a digital bank account. So there are many different variants of crypto wallet in the world that users can pick from. Some originate from centralized global exchanges, and others are offered by smaller scale decentralized projects. But among them all, there are three different types of wallets essentially. There is a hot wallet, a warm wallet, and a cold wallet. And every form of wallet comes with their own pros and cons. It all depends on your intent to use the wallet, which we'll get into. But first of all, let's start talking about what a hot wallet is. So a hot wallet is the most popular form of wallet, especially for newer investors. So when I say newer investor, I say between the years 0 and 3 of investment knowledge and ability in the market. So a hot wallet is 100% connected to the internet at all times and are typically held on exchanges such as Binance, Coinbase, Kraken, Crypto.com, etc. There are many pros and cons to everything, and hot wallets are no variant to that. So the pros of a hot wallet is that it's very convenient and easy to use for the vast majority of holders. So you simply just make an account with an exchange. Again, it can be Binance, Coinbase, whichever. And you are automatically given a wallet to store your cryptocurrency on and to make near instantaneous buy and sell transactions. Another major benefit of a hot wallet is that if you would like to transfer your crypto from wallet A to wallet B, or maybe potentially you're purchasing, let's say, a car in the real world, you have the ability to transfer funds near instantaneously. Again, depends on the blockchain you use, but that's a different story. But you can, with a hot wallet, near instantaneous transactions and transfers from wallet A to wallet B. So that makes hot wallets one of the most beneficial, one of the most convenient, and quite simply, it's the most picked wallet variant out of them all. But again, there are cons to using a hot wallet, and they're actually quite large if you think about it, but we'll get through them now. So one of the major cons, and this is probably the biggest con of all when it comes to a hot wallet, is that there's a saying that's called "not your keys, not your crypto." You may have heard of it before, and that's because this saying was created based on exchanges where when you store your wallet, a hot wallet, on an exchange, you don't actually own the keys or your seed phrase to access that wallet, which means that you technically don't own your crypto. So this is the equivalent of having a bank account in the real world, but not having access to the account details to actually access your funds. If we take a step back, we refer to cryptocurrency as one of the best up-and-coming asset classes because of the whole reason of its self-custody finance. What that means is there's no middleman when you're creating buy and sell transactions, which typically in the real world, a fiat currency that we use, the Australian dollar, the US dollar, euro, whichever currency you may use, there's always typically a middleman, whether that's the bank, if you've got your money stored in the bank, whether that's a payment processor that your money goes through to go from person A to person B. In crypto, there is no middleman. It goes directly from you, wallet A, to your intended target, wallet B. And that's the whole reason why cryptocurrency is so popular. But when it comes to having a hot wallet, not your keys, not your crypto, that refers to the exchanges, in fact, being the middleman. And that when you still want to make a purchase or a sale or a transaction or you want to buy something from a shop, whatever it may be, the exchange still acts as the middleman because it's just like a bank. You're storing your money or your crypto on the exchange. Now, of course, that comes with security and safety where the exchange technically looks after your currency, makes sure it's safe and protected, although they are still prone to hacks, which we'll get to. It is the equivalent of a digital bank. And if you're trying to escape the middleman and trying to have self-custody with your cryptocurrency, an exchange probably isn't the option for you, which in essence means that a hot wallet probably isn't the option that you're going to go for. But nevertheless, that's not to say that you can't, again, buy and sell on the exchange. You absolutely can do that. But when we refer to not your keys, not your crypto, that majorly discusses the ideology that if an exchange was to go bankrupt or to have legal proceedings that require them to temporarily or permanently shut down, which we have seen before in examples such as FTX, then exchanges do in fact have the legal ability to use your currency, your crypto, to fund their legal fees or to pay their expenses, which does in fact mean that you could potentially lose your crypto. Now, I will bring some assurance that this does seem worrying, but the likelihood that an established exchange such as your Coinbases, your Binances, your Crypto.coms to go bust is very low. It's not zero, but it's extremely low that an exchange like those will get into such financial difficulty that they take your crypto. It's nearly impossible. But again, it's never zero, and especially for people who invest in smaller size exchanges and some foreign exchanges, wherever they may be, that potential to lose your crypto and your hot wallet is there. And that is the toss-up that investors need to make between using a hot wallet and our next form of wallet that we're going to discuss, which is a warm wallet. So warm wallets are semi-online based wallets that are typically accessed through third-party applications, also known as decentralized exchanges, with some of the most well-known warm wallets including MetaMask and Trust Wallet. However, there are companies across the world launching their own wallets, all with unique features to break into the growing market for self-custody, and users have the ability to pick and choose what type of warm wallet they want to choose based on the features they are offered. But regardless of which wallet users decide to go with, there are a number of unique features that warm wallets offer over hot wallets that make them an appealing choice to investors. One of the main benefits of a warm wallet is that every transaction is manually signed for. What that means is, for example, an exchange, when you press buy and sell, it does it automatically. But with a warm wallet and a cold wallet, which we'll get to, every transaction you do, a buy, a sell, a transfer, whatever it may be, users are required to manually sign for each transaction. This is an added level of security that you just don't see from exchanges. And for clarity, when we're talking about a manual signature, we're not talking about a pen and paper and signing an agreement. What we're talking about is clicking a button on the wallet that every time you make a transaction, you have to individually click this button that says, yes, I agree to sign the transaction. Simple as that. It's one additional step from a hot wallet, but that added security is actually quite massive when it comes to cyber security. But talking about cybersecurity, there are massive cons as well with having a warm wallet. And some of them are reliant on users' memory, and others are reliant on cybersecurity. So the first one massively is because it's connected to the internet at all times, it has the ability to be exposed to security risk and in essence be hacked. So if users don't practice safe use, so such as disconnecting your wallet from sites directly after use, so for example, if you are claiming an airdrop, or if you're staking, or anything like that, if you don't disconnect your wallet directly after completing your process, then the risk of being hacked or exposed is quite high. So that's only one of the two cons of having a warm wallet. The next one is a little less of a con, but more to do with user memory, and it's in fact misplacing your private keys or your seed phrase. So unlike a hot wallet where you don't actually receive them, at least now you have them, so you own your own keys and your own crypto. But if you forget your private keys or your seed phrase and you lose a login to your warm wallet, your crypto's gone. There's no way to recover it. It's not like there's a forget password. If you lose your private keys or your seed phrase, your crypto is gone forever. And this has happened to thousands of people across the world. You hear stories about it, especially with cold wallets as well, where people might lose their ledgers or stuff like that. It happens all the time. So I highly, highly recommend when you very first create an account, first of all, do not take a photo of your private keys or your seed phrase, because that's the same as posting it online. Once you take a photo, it's online forever. You don't want that to happen. You just want to get a pen and paper. This is when you want your pen and paper, and to write it down. Typically it's a 12 or 24 word seed phrase. You write that down on a piece of paper, make sure you spell every word correctly, and you write the numbers between 1 and 12 of what your words are. Now these words are randomized every time you create a wallet. You cannot choose the words, so there's no bias involved. But if you lose these 12 words, and especially if you lose the order of which the 12 words go in, because there is a specific order, you will lose access to your crypto. So it's not necessarily a con of having a warm wallet, but if you do in fact lose that, there's no backup. You will lose your crypto. So inevitably, if you trust yourself to maintain your private keys and your seed phrase, and you appreciate the added security benefits of manual signatures, then a warm wallet is most likely for you. But if you are a long-term investor, this third and final wallet, which is my favorite wallet, is probably the one you will choose to use for your long-term, and that is called a cold wallet. So cold wallets are used as 100% offline storage systems that are also known as hardware wallets. So some examples of hardware wallets are ledgers and trezors, if I said that correctly. And these wallets are similar as having a two-factor authentication device in your hand that is not connected to the internet. And every time you do a transaction, similar to a warm wallet, how you have to manually sign, for a cold wallet, that manual signature comes directly from your hardware wallet, which is in your hand. So what that means, because it's completely offline, it cannot be frauded, it cannot be hacked, it cannot be anything of the following that is a security risk. It is one of the most safest options that a user can select. Now, using a cold wallet is very similar to using a warm wallet. You still connect it to, let's say, third-party sites if you wish to create transactions. But when I say connect, you don't connect your, let's say, ledger, which is the hardware itself. You don't connect that. You use that as a two-factor to make the transaction via your phone or your computer, which is similar to a warm wallet. So what that means is that if you forget to disconnect, for example, your wallet from the site, although it still has the code, your account username, I'll call it, which is a random long digit of OX4N5, whatever it may be, everyone's is unique. That's your identifier on the blockchain. Although that it might still be connected to sites, a site cannot hack your wallet because the two-factor is in your hand. It is a hardware wallet that is not connected to the internet. So it's not possible to be hacked in that essence, which is a major benefit of having a cold wallet compared to a warm and a hot wallet. Now, when we're talking about the cons of a cold wallet or a hardware wallet, there's not that many to do with safety features or use case. However, the one biggest con is more to do with convenience. Now, every time you want to make a transaction, again, this includes buying the groceries or simply transferring crypto from wallet A to wallet B, you need to have that ledger or that hardware wallet in your hand at all times. So what that means is walking around with a second device that has to be in your pocket at all times if you are daily using your crypto. If you're someone who just wants to, in essence, store it in a safe and forget about it for 6 months to a year to 5 years, etc., this is not a concern for you. It is just another item in your safe that when you do eventually make that transaction, all you have to do is get it out and use it as a two-factor. But if you're somebody who makes multiple transactions a day, storing it on a cold wallet may not be the option for you because the requirement to two-factor authenticate / manually sign every single transaction will just delay trading times. And if you are someone who snipes the market, which means buys and sells within a matter of minutes, then cold wallet would just delay too much time and you wouldn't get the best value for each crypto you purchase. Now, let's quickly pause and talk about one important fact for warm and cold wallets. These are applications and hardware wallets that do not store your crypto. They simply give you a secure access to your crypto, which is stored directly on the blockchain. I refer to these apps, the warm wallets are apps, and the hardware wallets, being the cold wallets, as portals that allow you to access your funds. Only your private keys and your seed phrase is needed to be able to access your funds. What I mean by that is if you do in fact forget your login on the warm wallet on the computer, or potentially you lose your cold wallet / your hardware wallet, as long as you have written down again on a piece of paper your seed phrase and your private keys, you can simply log back in with your details to the application that you use, or if you purchased a second hardware wallet, you can log in with the same details and your funds will still be there. So this is the difference between a hot wallet and a warm / cold wallet, is that your crypto on a cold and warm wallet is stored directly on the blockchain, which is only accessible via your seed phrase and your private keys. Whereas the funds on your hot wallet, which is stored by the exchange, your funds are lumped together with every other investor into what we call this one massive hot wallet, which is owned by the exchange. And if you were to lose your login for the exchange, you simply have to just do a forget password, potentially show some real world authentication to say it is you, i.e. a driver's license, age card, whatever it may be, and you'll get access again to your hot wallet. Another small element of talking about this is, for example, if you started with a warm wallet, so let's say I started with MetaMask online, and I decided to purchase a hardware wallet. Let's say I purchased a Ledger, which is a brand of a hardware wallet. I don't have to create a brand new account on the ledger. I would recommend it because it refreshes your security. But if you wanted to simply transfer your account that you've already created using the same seed phrase and private keys, you can absolutely do that simply by opening your hardware wallet, typing in the 12 words in the same order that they were given to you initially, and you could simply log into your account and all your crypto would be displayed right there. The easiest way I could describe that through using a real world scenario would be, let's say you're with Commonwealth Bank, for example, and you decided to walk into a NAB bank or a Westpac bank and you just ask them to get your money out. On an ATM, you could do that, but there is a fee, but you can't typically go into a branch of a different bank that you bank with and ask for your money. Whereas in this case, you pretty much can, because with a warm wallet and a cold wallet, you're not storing the money with that bank or that location. It's stored on the blockchain. You're simply just logging in with a different wallet and you can access your funds via what I call, again, the portal directly onto the blockchain. So these are the three wallets that users can choose from: a hot wallet, a warm wallet, and a cold wallet. One last feature I'm going to bring up is the key terms when we're talking about private keys and public keys. When I talk about private keys, that is the information that is absolutely private. You never share it to anybody under any circumstance. That is the equivalent of your bank login details, your PIN code, etc. So you will never give that to anybody under any circumstance. But when I'm talking about public key, which is what I briefly brought up before, that is what we call, let's say, your username or your email address. That is what you use to receive funds. It looks quite similar to a massive 30 or 40 digit number that starts with approximately 0x, 4n, 5f, gh, etc. It goes for 30 or 40 letters. That is unique. That will be seen on the blockchain. That is a public key. That is not something you need to hide because it's simply just your username. If people have access to that, yes, they can see the transactions that you've done on the blockchain. Let's say you've bought a certain project of crypto, or maybe you've gone to the real world and purchased your groceries. They can see exactly what crypto you spent, how much you spent, what was the gas fee, the date and time. That's unchangeable, and that is what we put on an actual ledger. It's like an accounting sheet called a ledger. That is unchangeable, untangible. It'll always be the same forever. That is a public key, and that is okay to share. And inevitably you will need to share that because that's how you will, in essence, receive crypto as well as send crypto. So these are the two key terms that you should know: private key and public key. Again, do not ever, under any circumstance, share your private key, but your public key is okay to share. Hopefully this has given you a greater understanding of the three wallet types. Again, hot wallet, warm wallet, and cold wallet. It's now up to you to take this information and to decide which option is best for you, your investment style, and what your goal is in the investment world. My name is Chris Shepley. I hope you found value in this, and as always, trade smart.